What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by the Bond King, Stephen Van Metre, president of Stephen Van Metre financial planner, portfolio manager, runs a YouTube channel, among many other things. Stephen, how are you?
Great, Jay. Thanks for having me on your show today.
I'm really happy to have you on. I'm excited to dive into some topics with you. This is the first time we've had you on our show. So for anybody who's not familiar, could we begin with a bit of a highlight reel? Stephen, where do you focus your time and what do you do?
Yeah, good question, Jay. You can find a lot about me on my weekly macro show on YouTube. I'm active on Twitter, Facebook, LinkedIn. And I'm a portfolio manager. I've invented a formula-based strategy called Portfolio Shield, which you can read more about on my website. And I'm also managing macro fund.
Okay, now a handful of buckets I want to jump into with you today. The majority of my audience comes from a precious metals investing background. And as a consequence of that, we get a lot of consistently audacious gold forecasts. You have a contrarian standpoint, which is why I wanted to have you on. So I wouldn't call it a prediction, but you made a case for $1,300 gold, correct? And I'd love you to walk us through that a little bit.
Yeah, and you're right. There, when it comes to gold, you do get a lot of these big numbers. I think it's kind of like Tesla stock too. You just get big numbers. When I look at gold, it's not always inverse the dollar, but it's frequently trading inverse the dollar. Now, a lot of people think the dollar is going to the toilet, and maybe even farther down. And I have a completely different view that the dollar is going to rally. And when I look at gold, and I look at how it's traded up from 1,300, it hasn't traded on a lot of volume. And as you look at the price structures moving up to current price, and you go back down, you find out that there's not a lot of what we call support from a tactical perspective. And so all support really is where buyers are at and where are those buyers that don't want to sell, that if prices came back down to that level, they'd buy more. Well, that number is 1,300. There's a massive amount of buyers at 1,300. But between 1,300 and where we're at now, there's not a huge amount of buyers to support this. So if we get a dollar rally, which I believe we will, then there aren't a lot of people there to hold gold up. So I'm looking at 1,300. Now, could it hold up around 1550? Sure. I could be completely wrong. I'm just looking at it from a volume perspective. Is 1,300 is where the buyers are at. And my gut feeling is if it gets down to 1,300, we're not going to see those buyers sell.
Got it. Okay. Now, that makes sense, especially relative to a rising dollar. So my next question, therefore, is what's your case for a rising dollar?
Yeah, and that's a lot has to do with quantitative easing and how quantitative easing works. And a lot of people believe that QE is designed to weaken the dollar and raise interest rates. But in actuality, it's designed to do the exact opposite. It's designed to lower interest rates to spur lending growth. And it's designed to kind of not remove dollars from the system, but put them in what I call a dollar prison, lock them up into the banking system. So that way, even though we can account for them, we can see them, they just can't move around a lot. Kind of like an actual prisoner. They are a citizen, they are part of society, but they're locked in somewhere, and their productivity as part of the society is, well, rather limited. So when you understand that QE is really a dollar prison and that it causes the velocity of money to slow down and continue to fall, because even though there's a lot of dollars, they're just stuck in the commercial banking system, that over time, as the Fed continues to do QE and continues to trap these dollars, well, the dollar is going to rise. And on the back of that, we already are in a dollar shortage, partially due to quantitative easing. But the main reason we've seen the dollar fall is just due to massive amounts of short positions, either on the dollar or long positions on foreign currency. So you have this perfect recipe where QE will eventually work its way through all these short positions, cause the dollar to rise. And that's really what the Fed wants anyways, because what is the ultimate goal of QE? Well, it's to get American consumers to borrow money. Why? Because it creates money in the system. Mm-hmm. Well, how do you get that money out broad? And how do we do that? Right, Jay, if you and I were going to think through this and said, how are we going to get dollars out of the US into foreign countries? Well, it's real simple. I want a strong currency, so foreign produced goods and services are cheaper, and then I'm going to borrow money and go buy them. And so when you start under really examining what QE does, lower rates, stronger dollar. And if you get that stronger dollar, then, like I said before, you could see gold move with it. But there's too many times that there's an initial shock that drives gold lower.
Okay. Now bear with me because this is not my area of expertise. But so if I'm tracking you correctly, yes, the assumption would be you increase the money supply, you increase the velocity of money. That would be a logical correlation. But in fact, the opposite occurs. So therefore, even though you're increasing the supply of the money, since the velocity of money is dampened, the money itself is still relatively scarce. Even though there's an increased supply of it, there's less of it sloshing around. Am I kind of on the trajectory here?
Yeah, and so let's kind of dig deeper in that, if you don't mind, about this money supply issue, because that's really kind of the crux of this inflation view. Is everyone they look at the year-over-year rate of change of the money supply, that we're kind of at that annual anniversary, and for the last 12 months, this is going to be massive inflationary because QE causes an increase in the money supply. That's actually completely backwards. QE is a money supply Pac-Man. I mean, it chews up the money supply. It needs a rising money supply. It doesn't create it. It's an effect of QE. So let's kind of dig even deeper in that. How does that even happen? How do we get this money supply growth from QE? Well, the whole point of QE is to, again, lower rates. And depending on the size and the scope of a QE program done by a central bank, if it's broad-based across, short-term to long-term interest rates, you should see the whole curve come down. If it's focused on the front end, you'll see short-end rates come down. But the whole point of why you see money supply growth in tangent with QE is because, savers go down to the bank and they start building up their savings. And normally they'll say, well, my emergency savings is at the limit, and now I have a buffer. So I'm going to take that extra amount and I'm going to put it away at a little bit longer term where I can earn a little bit higher rate. Well, the problem with QE is it slams those rates down, where a saver says, why would I go put my money in, say, a 5-year CD and tie it up where there's a penalty to get it out when there's a literally negligible increase in return? So what you start to see is this money supply growth because savers have nowhere else to put their money. There are higher yields. You see corporations just parking their money in cash. And so that starts to grow the money supply. And then everyone gets excited that, okay, that's inflationary because this money is going to come out of the money supply. But that's not how it works. So as the money supply grows, the bank has to pay interest on this money. Now, granted, it's not much, but they still have to. Yeah. And so how does the bank get the interest to pay depositors on their money? Well, they take those deposits and they convert them into reserves. And all that means is they go and buy treasury securities. Right. That's all it means. So now all of a sudden you have depositors who don't even know they're funding the U.S. government debt, which is really interesting. I think a lot of people listening right now are like, I'm funding this deficit. Yes, you are. You absolutely are. So you've got the bank, now has these reserves, these treasury securities. The Fed comes along and through QE and says, hey, bank, I'm going to swap that reserve with you. So you might be holding a 5-year treasury note right now. I'm going to give you an overnight reserve. I'm going to swap with you. That's what QE does. So in order for the Fed to keep doing QE, they need more reserves. In order to get more reserves, they need more banking deposits. Well, how do you get more banking deposits? You need to keep rates so low that depositors have no other choice.
Right.
That makes it's kind of so now. Okay, now here's where it gets really interesting. Are you with me so far?
Yeah.
Okay, so that reserve swap that the Fed does. Let's unwind it just briefly. When a bank creates a reserve out of treasury security, they have the power to undo it too. So if there's a big demand from depositors for cash, they can just sell the treasury security, get the cash, and meet depositors' needs. Now, when that swap occurs, that reserve asset that the banks are given, well, they're not actually given it. It's actually held at a Federal Reserve member bank, and the commercial banks can list it as an asset on its balance sheet. So from a balance sheet perspective, there's no change. We have a reserve to begin with, swapped to a reserve asset. But the Fed now is in control of this reserve asset. The only way to undo that is through quantitative tightening. So what kind of happens here is this reserve asset can only move inside the commercial banking system with banks that are eligible to handle reserve assets, who are part of the QE program. And by doing that, it limits the velocity of it, limits the movement of it. Now, if we had a large number of commercial banks, let's say we had like a couple thousand of them that were part of the system, well, then that reserve asset could move all around. But when you have like a small number, and I don't know what the exact number of, 10 to 20 of these, the velocity, the ability of that money to move around is very, very low. And so that's why if any of your viewers were to chart the velocity of money against the monetary base, is where we see this pickup in the Fed data, and you take the monetary base and you invert it, you'll see very clearly, like, wow, QE is a velocity crusher. Yeah, that's exactly what it's supposed to do. It's supposed to put these dollars, and through this swap mechanism, it puts them in a prison.
Now, is this possibly behind Jerome Powell's recent statement where he said there's no longer a relationship between the quantity of the dollar and the value of the dollar, which is, again, it's counterintuitive, right?
Right.
But you wrap your mind around that, you're like, either he doesn't understand basic economics or he's just trying to pacify the population, but maybe there's more to it, and that's what you just explained. Is that related?
Yeah, I think that is. I didn't catch when he said that, but effectively, right. He's got a lot of dollars out there, and what he wants to do is make it worth more. Well, he can't destroy them. He doesn't have a mechanism to destroy it. The only way to destroy a dollar is to apply it toward the principal value of a loan or as part of a regular payment. Any principal payment on a loan destroys a dollar. So what could he do? Well, he can do one thing: lock them into the commercial banking system where they can't move around very much.
Right. Very interesting. Okay.
Well, that way the other dollars, right, that are outside it become hopefully worth more. And as they get stronger, then that incentivizes people to come back to where we started originally, is borrow money and maybe go buy that foreign car, take that foreign trip, or invest outside the US and get those dollars out there, where the euro dollar market really can start multiplying them, because a lot of our dollar denominated debts are held outside the US, and there's a demand for dollars to meet those. Well, the Fed has to get dollars outside the system, but they have, again, no mechanism to do that. They can't just write a check and say, here you go. So the only way they can do it is get American consumers and businesses to borrow money, spend that abroad. And the only way you can do that is lower interest rates and increase the value of your currency, which is completely the opposite of what everyone really believes right now.
Yeah, no kidding. It is a very uncrowded bet going long dollar. So you know what? Actually, recently I had Brent Johnson, who you must know, Peter Schiff, and Raoul Powell on a panel, and they were debating. I was just moderating. It's called the top asset class for 2021, and Raoul was long Bitcoin, Peter Schiff gold, and Brent the dollar, obviously. So. Brent and Peter have had a similar bet at my event every January for the last 2 years, and this being the third. They're now betting whether or not the dollar will rise or fall in the 12-month period. Obviously, your money's on Brent for this one.
Yeah, absolutely. Brent will be right in the end. There's no question about that. And again, it's all because of what QE does. And then you start to connect the dots. Is, well, if QE causes the dollar to go up and interest rates to go down, that means the bonds are going to go up too. Well, then you start looking at the relationship between bonds and dollars, and you start figuring out that a dollar is just an overnight duration bond. So, and they're not perfectly correlated. There's times they separate, but generally they'll follow the same direction. So yeah, Brent will be right in the end. The only question is, how long will he have to wait to cash in on this bet? Yeah,
he may re-up another couple of years. Okay, interesting. Now, Stephen, the question I have to ask is, what could make this wrong? What could make you wrong with this prediction?
Yeah, that's a good question. So if you don't mind, I want listen. Can we dig into what a liquidity trap is? Because that's really where you see the where Steve is wrong view come out.
Please.
Okay, so we kind of talked about how the money supply is not going to lead to inflation. So what happens when a central bank does quantitative easing, we get into what's called a liquidity trap. Now, if you actually went out and talked to a central banker, they're going to tell you this doesn't exist. And Jay, the way I like to frame this is, it's kind of like a black hole. So if you and I point a telescope at a black hole, and we'd be, I can't see it, right? Because it's black. It looks like space. But if we zoom out and look at the event horizon and look at the circumstances going on around it, we go, okay, we can see that. And that's a problem with central bankers. You mentioned the word liquidity trap, and they start shaking their head and go like, nah, that doesn't exist. Well, what happens in a liquidity trap is the demand for money. So we kind of talked about the demand for money being QE. QE has a demand for deposit money to be converted into a reserve, to be converted into a reserve asset through QE. When the demand for money is rising more proportionally than the money supply, you get disinflation or deflation. In fact, that gap that gets created has to be filled by lower consumer prices. So not only are we likely to see the dollar rally and bonds rally and interest rates fall, we're likely to see consumer prices fall. Again, another view that very few people have. So why did I want to go through this? Because how does a planet or an object escape a black hole? Well, there's some very, very small ways it can happen, but it is possible. And the same is true with a liquidity trap. Because a liquidity trap is created by QE, the most obvious way out of it would be for the Fed to do quantitative tightening and raise federal funds rate. What that would do is take all of these dollars in the depository system and give them somewhere else to go. But Jay, you listen to the Fed meetings, press conferences, I know, as much as I do, and the Fed's not going to undo QE anytime soon because the perception is that it's a good thing. So there's one check mark that we can say is not going to happen. The second way out of liquidity trap is lending growth. So this is where you get consumers and businesses out borrowing lots of money. And why does that work? Because that's how money is created into our system, is when people borrow. So we need money to get out of this problem, and that's how it's created. Well, let's go to step 3 before we come back and dig into step 2. There's a third way out, which is fiscal stimulus. Now, a lot of people are probably thinking, aha, okay, we're doing that. The problem is not only do you need a massive amount of fiscal stimulus, you need continuously increasing amounts of it. And why do you need it? It's because you need to create lending growth. See, lending growth is really the only way out of this whole trap. And we kind of know that because today, as we're recording this, the Chicago Fed National Activity Index came out for February and showed we went from positive growth in January, although a much slower rate than months before, to negative, which means we had below average growth in February after we had a stimulus check in December. So what you find out is these stimulus checks just don't work because of, again, the negative impacts of QE. So how do we get out of this trap? Well, one, the Fed unwinds and does QT, not going to happen. Raise federal funds rate, not going to happen. Congress does infinite amounts of fiscal stimulus. They can't do that, not enough money. So the way I get to be wrong at this moment in time is if we get a massive amount of lending growth.
Okay. Now, so let's walk in another path here. We do see the dollar rise this year significantly. I think you said, and correct me if I've misquoted you here, foreign governments hold more U.S. dollar debt than the U.S. Is that, did I get that correct?
Well, they hold a lot of it. I mean, don't get me wrong. There's a ton of dollar debt here. The problem is it really is the dollars outside, because how do they get dollars? Yes. Right? If I'm in the U.S., Jay, you're in a foreign country. You don't live in a dollar world. You need dollars. Well, how do you get them? You get them from people in the U.S. to spend them over there. So they have effectively a dollar shortage, and that kind of feeds into, again, the strengthening dollar is their dollar shortage creates a demand for dollars, which also leads to a rising dollar. I think that's more along Brent's dollar milkshake view, is this shortage of dollars in the foreign market leads to a greater demand for them.
And what's the impact on these foreign nations that are holding U.S. dollar denominated debt in a rising dollar environment?
For them, that means their currency is going down, or what in their case, what you look at is the Fed does not have the authority to print money, but there are a number of foreign central banks that can. So what would happen is to get dollars, that they don't have to pay on their debts to keep from defaulting, is they could print money and sell, dump their currency on the market to get dollars, which would devalue their currency and increase the value of the dollar. So for them, a weaker dollar has been beneficial, easier to get. A stronger dollar means, it costs them more to get it.
Right. It sounds like a death spiral.
It is.
Right. Okay.
It is absolutely that. I like to use the phrase, a rising dollar is the pin that pulls a grenade on this whole thing. Right now, it's being held into place, but when the dollar rips higher, it will be unstoppable. I mean, it will be worse than a bull in a china shop because there will be so much demand for it. And there is a massive shortage of it created by QE. So the longer we do QE and the less lending growth we get, the worse this is in the end.
Which would then therefore lead to a string of sovereign debt crises in other nations who are holding US dollar denominated debt. When they go belly up, then, I mean, I guess the US is left holding the bag, correct?
Well, or even worse, they just print more money. It drives the dollar up higher. And then you see what happens at US stocks. They start crashing. And then all of a sudden, oil, all this inflation stuff crashes. You get a deflationary shock. You get a financial crisis. And then you have a problem because it's still, you don't have enough dollars being created to start servicing debt. You get more defaults. And the pandemic has really pushed that off because banks have been told not to foreclose or not to default on these loans. Well, all of a sudden now you've got this really high dollar. You've got everybody needing it. And then, like game of musical chairs, the music stops. And well, we've seen this happen in the great financial crisis. There just isn't enough money to pay the debts. And people default. That is what a liquidity trap is a shortage of dollars. And the problem is you can patch it, right, by fiscal stimulus. Like, the government can send you a check, Jay, and you can pay your bills. But the problem is what happens next month, right? And you're like, well, I'm short again. Oh, here's another check. Well, at some point they're going to say, hey, you're on your own, pal. We've been giving you a bunch of money. You need to figure it out. Well, the problem is there's not enough jobs. There's not enough dollars. And eventually there is a point where if you don't get that lending growth, which we're not seeing because now interest rates have been pushed up by speculators, and a lot of people think that's reflationary. Now it's the exact opposite. In a liquidity trap, higher rates lead to less demand because people aren't borrowing out there. And we've seen that in the lending data. We're starting to see that in the housing data. And people are rejecting higher rates. And ultimately, that is another factor of how you get to even lower rates. Why liquidity traps lead to new all-time lows in yield is because you need this, them to be so low to get people to go out and borrow money to create more money. It's just the fiscal stimulus has just really pushed this can down the road, and in my view, is only going to make it worse when it does eventually happen.
Okay, interesting. So that's walking down that road a bit further. Then that is what you are forecasting through to the sovereign debt nation crises, leading back to, I guess, massive crises in the United States. And when you say kick that can down the road, I mean, I hate to ask people for time predictions because I don't do it, but do you have a horizon, Stephen, that you're thinking about right now?
I don't, because the banks I know are being told not to default on loans. I know a lot of consumers haven't been paying on rents, haven't paid on mortgages, haven't paid on their bills. The question is when they're going to be required to start doing that, and that's when we're going to find out that, wow, this situation is really a lot worse than we actually believe it to. Because if they've been paying on their bills this whole time, we would know it. I mean, we'd probably be in a whole different situation, having a little bit different conversation right now of, wow, the economy is just cratering because all these people are being forced to pay on their bills. Instead, they're out spending money on goods and services and then saving money, which we're seeing in the deposit numbers. But once they have to start making good on their debts, then we'll truly know the scale of the dollar shortage. And at that point, the dollar rips. And when it does, everyone, they're going to wish it did. I promise you, they'll wish it didn't.
Right. Okay, because the rising dollar is ultimately worst for the Fed. Right.
Yeah, because they can't stop it.
Yeah,
they're going to have to do so much QE, and see that's where you get down the spiral, right? I think you kind of mentioned it a few minutes ago. Is you can't stop it. So when people come back to like, how can I be so bullish on bonds? It's because the Fed's going to, if you thought what they did last March of $1 trillion was a big deal, wait till you see what they're going to do when the dollar skyrockets and they have no ability to stop it. They're going to do more QE. But now you and I just discussed the fact that actually makes it worse. And ultimately, what they're going to do is slam rates down so close to zero or zero. I think we'll see parts of the curve go negative. They're going to have to do it again because, well, first they've convinced everyone that actually does something, but to get rates so low to create inflation expectations and lending growth to get out of this mess. But yeah, the rising dollar is a problem because the Fed doesn't have the ability to stop it. Got it.
Okay, so that's the trade from your perspective. You're long long bonds, US dollars for now.
Yep.
Until some sort of event like this starts to materialize. And then where do you think it go? Is it emerging markets? Is it back to hard assets like gold, off-grid, Bitcoin? Where do you look?
Yeah, good question. Is because I think the CPI is going to go negative on a year-over-year basis. So a lot of people out right now we're shaking their heads and going, there's no way. It's possible. You see it if the dollar rips higher. I mean, gold, you're going to see crude and food prices just completely tank. You look at the core CPI; it's not even reacting as if there's inflation. So the CPI goes negative on a year-over-year basis. What is it I really want to buy? What would be my number one choice? Gold mining stocks.
Gold mining stocks.
Number two, emerging market stocks. Because why? Those are your big two sectors, or you can do precious metals, whatever you like. But those are where you go when you see a negative CPI print, because when it goes up, you can't not get inflation. Now, how high it goes, that's, I don't know. That's a different story, but that's where you want to initially start out, is go from bonds into inflation sensitive assets.
Why hasn't CPI been recognizing inflation? Is that just like a formula issue? What do you think?
It's QE. QE is deflationary. So you kind of, if we summarize everything we've talked about, you could say QE is deflationary until we get lending growth, and then it becomes inflationary.
Okay.
So if that's really the basis of, and what QE is designed to do, it's designed to, again, remember we talked about that liquidity trap. So where that demand for money is growing more proportionally than the money supply. Well, what happens is that gap has to be filled with lower consumer prices. And so when you hear people reporting on the CPI every month, they go, okay, well, next month, this part is going to go up. And then the next month comes along and that part does go up. And then another part goes down. And then the month after that, it keeps they keep saying everything's going to go up. But because of the liquidity trap, if something goes up over here, something's got to go down. So if crude oil prices and gas prices go up, then you'll see other parts go down because there's a shortage of money. And so when everyone gets excited about, and I think you'll appreciate this, Jay, everyone is like, okay, when the economy reopens, right, massive amounts of inflation. And I go like, no, you don't understand. It's going to be worse because the limited supply of money is now going to get stretched across more businesses. And so what have we already seen in the unemployment data? We've seen people lose their jobs in the pandemic, go back to work, and now they're losing their jobs again because there's a shortage of money. So the more businesses, the more people working, nope. What we saw it in the hours worked, they dipped a little bit. It's like, wow, that people like that shouldn't happen. It doesn't. Liquidity trap happens every time.
Interesting. So coming out of this, vaccine-led recovery, if you're choosing between the economic boom of a lifetime as everybody gets back to work versus coast to coast insolvency event for small to medium businesses, I think I know which camp you're landing in right now. Yeah,
as long as the Fed's doing QE and there's no lending growth, which if we looked at all loans and leases across commercial banks, you're looking at 2 to 3% year over year lending growth, which it really needs to be a lot higher. It needs to be 6 to 8%. So we're not seeing that. And then you look at what are consumers doing with their stimulus checks, right? Saving, a third is savings and a third is debt payoff. Well, we already talked about that paying off debt destroys money. So stimulus is not even inflationary. It's actually disinflationary. It can be deflationary. So yeah, I'm definitely on the fact that please reopen the economy. You're going to find out that the liquidity trap is real and is not what investors are expecting at all.
Interesting. Stephen, look, this has been fascinating and very educational for myself. So thank you. Thanks for making the time. Thanks for coming on the show. And I'd love to do it again sometime.
Jay, anytime you like, let me know. I'd be more than happy to come back and speak with you and share more of my views with your audience.
I have to get you on with a few people. Maybe we'll call up like a Brent Johnson and a Raul, and then somebody else to provide a counter argument to this. That would be fun. But let me set it up and I'll get in touch.
Okay, I'll look forward to it.
Thanks again, Stephen.
Thanks, Jay.